Mises Fellow and Professor of Economics in the University Rey Juan Carlos in Madrid. He's the assistant editor of the Procesos de Mercado, Market Processes, a Spanish and English bilingual journal edited by Jesus Huerta de Soto. He has published articles in the Journal of Business Ethics, American Journal of Economics and Sociology, Independent Review, the Quarterly Journal of Austrian Economics, Review of Austrian Economics, New Perspectives on Political Economy, the Journal of Libertarian Studies, and other scholarly outlets. He's also the author, as you heard this morning, of 2 wonderful books. He will address us today on eliminating monetary externalities. I introduce Dr. Bagus.
Thank you, Joe. Good morning again. Well, let me first express the deep honor that I feel delivering the Rothbard Memorial Lecture 2011. It certainly is the greatest honor that I have received in my young career, even though I don't think I'm so young anymore. When I was interviewed for Mises.org's faculty spotlight, one of the comments were, "He looks like 13. I can tell you, appearances are deceiving sometimes. And of course I thought, no, well, Philip, now you have a problem, because who will take a 13-year-old seriously? What shall I do? Shall I grow a beard? Or what? I then thought, well, finally time will take care of this problem. Jeff Tucker also wrote in the description of my book, the young scholar Philipp Bagus, who predicted all things what will happen with the euro correctly. Well, not 13, it's 30 and counting. But then I thought, maybe, Philip, you have problems that other people would like to have. But anyway, I will try to make good use of this lecture, something that Rothbard would be proud of. I owe him a lot. It was through his Ethics of Liberty that I discovered all the implications of my libertarian genes. His clear economic and political prose was very inspiring for me. And I owe him another one, what I talked about earlier. I first wanted to call my book The Case Against the Euro in honor of Rothbard's great The Case Against the Fed. So I feel a bit sorry that I eventually did not do so, but I will try to make up for it. Finally, I decided to call the book The Tragedy of the Euro. And not only for the reason that the euro has proved to be a tragedy for liberty in Europe and will be so in the future, but also because a main argument, or maybe the main argument of the book, is that it is a tragedy of the commons. And this concept, the tragedy of the commons, made me think on the subject of monetary externalities. And there's not much written on monetary externalities in the Austrian school. We have Huerta de Soto, who claims that fractional reserve banking is a tragedy of the commons, which implies negative externalities from money. But there's not much else. There's not even a thorough. There's not even much on externalities as such in the Austrian school. Rothbard, for example, he dedicates only roughly half a page in Many Economy and State on externalities, even though he uses a slightly different terminology. He calls negative externalities external diseconomies or external costs, a term which he doesn't define explicitly. He just states, quote, "But cases of external diseconomy all turn out to be instances of failure of government, the enforcing agency, adequately to enforce individual property rights." And then he gives us the typical example of air pollution. For further information, he refers to Mises, quote, "On external diseconomies, the only good discussion by an economist is the excellent one in Mises' Human Action, page 650 to 53. So even Mises has only 3 pages on externalities. So I would like to go into more detail today. I will first try to reconstruct externality analysis and then apply it to money, analyze different layers of it in money, and then propose several reforms to eliminate some or all of these externalities. So I hope you're now ready for my 30 years of accumulated wisdoms to come to you now. Well, the mainstream definition. Orthodox textbooks often define the externalities as uncompensated effects of actions on third parties, on bystanders, not participating in a particular action or exchange. Typical examples are someone smoking next to you in a restaurant as a negative externality, or a neighbor planting flowers in his garden that look nice as a positive externality. And then the literature goes on to distinguish between psychic, pecuniary, and technological or real externalities. Psychic externalities are defined as resulting from, or they are internal feelings that a particular action invokes on third parties. Such a feeling would be the nice view that the beautiful neighbor's garden provokes. Pecuniary externalities result when actions affect third parties indirectly through the price system. So when a new restaurant opens in a neighborhood, it tends to have a negative pecuniary effect on competing restaurants. Finally, real or technological externalities are defined as the direct effects that actions of some firms have on the physical output of other firms affecting its production function. The typical case is a factory that pollutes a farmer's field, so the crop production, the physical crop production of the farmer is harmed. So we can see a physical destruction of the property of a third person. Unfortunately, this mainstream taxonomy of externalities is very problematic and not very useful to analyze problems of the real world. First, the definition of externalities seems to be too broad. Any action may have psychic, pecuniary, or technological externalities. So psychic externalities, the planting of the flowers by the neighbor may have negative or positive externalities on all bypassers. Negative because people might be allergic against flowers, would be a negative. If the neighbor puts a photo of his beautiful garden on the internet, on his blog, then all internet users may be affected positively or negatively. In other words, any action that is known to third parties may affect their well-being. Regarding pecuniary externalities in a society with a high division of labor, a consumer buying chewing gum in China may have a pecuniary externality on all other producers worldwide, because the money that is spent on chewing gum cannot be spent on other goods. And regarding technological externalities, implementing scarce resources in an investment project affects the production function of all other firms directly. It may affect it directly. If I convince a famous singer to sing at my charity event for free, of course, the same day no other producer can use this resource in his production function. As such, the definition of externalities, the mainstream definition, seems to be too broad to be useful as an analytical tool. Second, the distinction between technological, pecuniary, and psychic externalities seems to suggest that they are both objective and subjective externalities. Yet externalities are only relevant for actors if they affect the subjective well-being of individuals. It is not the objective changes that are relevant, but the subjective perception of them. So there is no clear-cut distinction between real pecuniary and psychic externalities. Also, technological and pecuniary externalities affect the subjective well-being of third parties. Let's take the typical example of a technological externality, the pollution of a farmer's field. When a farmer produces fewer crops due to the pollution, his well-being is affected subjectively. If he wanted to produce fewer crops to increase prices, he might actually welcome the pollution. Also, pecuniary externalities are relevant to actors only if they affect their subjective well-being. It's not the higher or lower monetary income as such that is important to actors, but their subjective valuation of these changes. This leads us then to the question, why distinguish between technological, pecuniary, and psychic externalities if all affect the subjective well-being in the end? Why not only refer to psychic externalities? This leads us to the third critique. All externalities are psychic or subjective and individually experienced by actors. Therefore, the mainstream classification is flawed and, most importantly, puts aside and does not mention and thereby hides the true and only meaningful distinctive characteristic of externalities, which is the poor definition and defense of property rights. The poor definition and defense of private property rights is objectively discernible from the outside. In fact, if other effects resulting from actions that respect private property rights are relatively uninteresting, because all actions may have effects on third parties in the sense that they may affect their subjective well-being. But actions that do violate private property rights and inflict damages on the property or health of third parties pose important theoretical questions. Those actions may be called irresponsible, as they do not account for the effects resulting from the ill-defended property rights. Consequently, I, in line with the Austrian analysis, will define externalities as effects of actions that affect third parties and that do not respect private property rights. It's in line with Mises. For him, positive and negative externalities, or what he calls them external benefits and costs, occur when a proprietor does not assume the full advantages or disadvantages of employing property because of ill-defined or defended property rights. So here we have, and they often generate perverse incentives harming third parties, which we'll see later. Here's a table where we have positive and negative effects on third parties. In the first row up, where property rights are respected, in the second, where they are not. So where property rights are respected and they have positive effects, the example would be savings and investment. There's capital accumulation, productivity rises of labor also, and wages tend to increase. So there's a positive effect on a third party, which is the worker, whose real wage tends to increase. Another example would be a divorce. A couple splits up, so it might have a positive effect on someone who was waiting for one of those two. Or a typical example is also a lighthouse. It's for all people that want to find their way. Even if they didn't pay for it, it shows the way. It's a positive effect, no violation of property rights. Then negative effects. Here, where property rights are respected, a boycott, for example. I convince someone not to go to McDonald's, negative effect for McDonald's, but no property right violation. On the other hand, we see that anything may be in any case, the divorce may have a negative effect on someone because there's suddenly more competition in the marriage market, affecting someone there negatively. Another example would be gold production in a 100% gold standard, that prices increase, but there's no violation of property rights. Let's now go to the ill-defended or ill-defined property rights. Positive effect. A tyrannicide. Someone kills a tyrant, so for money subjects that will have positive effects. Another example would be someone kills your competitor in any market. It may have a positive effect on you. Property rights violated. Another example which shows that one action can have positive or negative externalities would be air pollution. I have a house with white walls, then there's air pollution, they get dark. I contract painters to paint it white again. Positive effects on the painters caused by ill-defended property rights. And we see that this is also an example for negative externalities, because I have to pay the painters. For me, it's a negative externality. Another example would be of a negative externality violating property rights, a wealth tax. Reduces capital accumulation, tends to reduce productivity, wages tend to be lower than otherwise, a negative effect on third parties. Or public roads, that suddenly immigration without invitation is possible. So, what is there in the circle? This is what I define as negative externality, because there's a negative effect on third parties and property rights are violated. I might add that ironically, the mainstream analysis has used positive effects that do not violate private property rights to justify property rights violations, which may then exert negative externalities. The lighthouse example, it has positive effects on third parties. They call them free riders that did not pay for the lighthouse. So they say it's justified to tax these people use violence, violate private property rights, and build the lighthouse with public money, which could then have true negative externalities. So now let's see if we can apply this concept to money. Of course, government manipulation of money affects its purchasing power. However, most manipulation of government does not affect the physical integrity of a fiat paper note. So from the mainstream point of view, there's no technological or real externality. Maybe even Rothbard would not see it, consider it as a negative externality. He points out in his discussion of external costs that in a free society, no one owns the value of a property. So no one owns the value of one's cash balance. Nevertheless, a criminal action may reduce the value of your property. So there can be violations in property rights in the monetary sphere that affect the value of cash balances and therefore constitute negative externalities. Here one must not forget that it is the services of a good that makes it valuable for an actor. And when property rights to money are not defended, the services it provides are affected negatively. Pioneers of this approach are Hoppe 94, or Hoppe, Hülsmann and Bloch 98, and Huerta de Soto 98, that refer to negative externalities resulting from property rights violations in money. And my suspicion is that the distinction between the value of the property and the physical property explains why these externalities resulting from meddling with property rights in money are sometimes neglected. I might add that even Rothbard might agree that there can be negative externalities from meddling with money, because he himself points repeatedly to the service a good provides in contrast to the physical content. Quote, "As a matter of fact, tangible goods are valued not so much for their physical content as for their services to the user, whether he's a consumer or producer. The actor values the bread for its services in providing nourishment, the house for its services in providing shelter, the machine for its service producing a lower order good. In the last analysis, tangible commodities are also valued for their services and thus on the same plane as intangible personal services. Economics, therefore, is not a science that deals particularly with material good or material welfare. It deals in general with the action of men to satisfy their desires." End quote. The same is true for money. What are the services of money? Well, money is valued mainly for its services as a medium of exchange and a store of value. People demand to hold money in their cash balances because they thereby reduce the uncertainty of the future. As Rothbard puts it, the desire to keep a cash balance stems from fundamental uncertainty as to the right time for making purchases, whether of capital or consumers' goods. Also important are a basic uncertainty about the individual's own future value scale and the desire to keep cash on hand to satisfy any changes that might occur. The service of money, of course, depends on its purchasing power. And here money is special, as the service it provides depends on its demand and supply. The higher the demand for money, the higher the services it provides tends to be as its purchasing power is bid up. And with the higher the supply, the lower the services a given unit provides tend to be. The lower the quality of money, the lower the services a given unit provides tend to be. What is also special of money is that its services may be affected even though the physical integrity of it is not affected. Even though the physical integrity of the existing dollar note in your wallet is not affected, the services it provides may be affected. So, let's look for the negative externalities in our present monetary system. In a gold standard, the production of base money or money proper respects private property rights. The gold money producers assume the full costs of money production. Even though prices tend to increase due to the money production, there's no violation of property rights or ill-defined property rights. No one has to accept the newly minted coins. People are free to use alternative currencies. Consequently, there are no negative externalities. In our modern monetary system, however, base money production implies negative externalities as it is not free and competitive. There's a money monopoly, which implies a privilege, violating private property rights, as no one is allowed to use his own property to produce base money. And this privilege is normally combined with legal tender laws, which present a violation of the freedom of contract and thereby also of property rights. People cannot use their property in the way they want, but must accept the legal tender in exchanges. As the property rights are violated, negative externalities may evolve, consisting in what? When the monopolist produces more base money, prices are bidden up, and the price increase harms third parties. Damage is inflicted on the purchasing power of money through a violation of property rights. Money held rents fewer services than it otherwise would have yielded. And it is these reduced services that present the negative externalities, in the same way as it is in the case of pollution of a farmer's field. The pollution leads to less services in the form of a lower crop and providing less nourishment. And the money producer, the central bank, does not assume, therefore, all costs of his action and will try to maximize his income out of the money production, at the same time attempting to avoid a breakdown of the monetary system, leading to a redistribution in his favor. This was about the production of the negative externalities due to the production of base money. Let's go to the negative externalities due to the production of fiduciary media in a fractional reserve banking system. Another area where property rights today are ill-defined and defended is in banking. In a deposit contract, the depositor entrusts to the depositary a good to guard, protect, and return on demand. So the fundamental purpose of a deposit contract is to maintain the full availability of the deposited good, which implies the obligation of custody and safekeeping of the good deposited. The bank's duty is to hold 100% reserves on these deposits. Consequently, it's both a privilege and a violation of private property rights if banks are allowed to expand credit and hold fractional reserves. Governments have granted the privilege to banks to hold fractional reserves. In other words, they have not defended the property rights of depositors. Banks can exploit the purchasing power of deposits entrusted to them, and the results are negative externalities. The creation of fiduciary media leads to an upward pressure on prices. The services from money held are reduced. Existing depositors lose purchasing power as the privileged banks have created new money. Another externality of fractional reserve banking is, production of fiduciary media, is that the quality of money is reduced. The quality of money is its capacity to fulfill its functions as a medium of exchange, store of value, and medium and unit of account. By credit expansion, the reserve ratio of deposits is reduced. Banks expand credits to grant loans for long-term investment projects. As a result, the average quality of assets that might be used to redeem deposits falls because banks acquire illiquid assets with the newly created money. Therefore, the money becomes a worse store of value. The quality of money is reduced. Another negative externality is that credit expansion also distorts relative prices. It makes economic calculation more difficult, and there may be an intertemporal discoordination in society, a business cycle, harming third parties. One may make the argument that in the case of our present fractional reserve banking system, we are not faced with ill-defended property rights, but rather with ill-defined property rights. In fact, it may not be clear for many parties involved if they deal with a deposit contract. Probably many depositors want a complete availability of their money, which is characteristic of a deposit contract. However, banks tend to regard the deposited money as loans granted to them. So it's not clear who really owns the deposited money. And bankers fail to make clear whether they have been authorized or not by the depositor to use the money. As Walter Soto states, quote, to fail to clarify or fully specify these details indicates a remarkable ambiguity on the part of bankers, and in the event that adverse legal consequences result, their weight should fall on the banker's shoulders and not on those of the contracting party, who with good faith enter into the contract, believing its essential purpose or cause to be the simple custody or safekeeping of the money deposited, end quote. So it's not clear in our present fractional reserve banking system what kind of contract is entered into, whether it is a loan or deposit. Without clear and unambiguous contracts, property rights are ill-defined, resulting in negative externalities. Thus, we may interpret modern fractional reserve banking in basically two ways. First, we may regard deposits as ill-defended, because banks have the privilege to use genuine deposits. Second, we may regard the property rights of demand deposits as ill-defined, because it's not clear what kind of contract is actually being signed. With both interpretations, modern fractional reserve banking system leads to negative externalities. And here we are faced with a special case of negative externalities, namely a tragedy of the commons, a term coined by Garrett Hardin. A tragedy of the commons is defined by two aspects. There's a rivalrous use of the resource, and there's non-excludability in the access of the resource. That is, many people can exploit it. A tragedy of the commons occurs in the case of unowned or common property resources. Mises calls this as an extreme instance of negative externalities, because not only one actor, but several actors can exploit a resource due to ill-defined or ill-defended property rights. The typical example is the harvesting of fish in the ocean. As property rights on fish stocks are not defined, anyone can harvest the fish, reducing the stock. All fishermen bear the cost, the burden of the reduced stock of fish, while the advantage of fishing is fully absorbed by the individual fisherman. Thus, there is an incentive to fish as many fish as possible, because otherwise other fishermen may deplete the stock. A tragedy of the commons thereby leads to a tendency towards the destruction of the common property resource. And we can apply the concept of the tragedy of the commons to banking, state Walter de Soto. Fractional reserve banks can exploit the common property resource, that is, the deposits of their depositors. Any bank can expand credit. Any bank that expands credit reaps the full benefit of the money creation, yet it does not assume the full costs, which are borne by all money users and also by other fractional reserve banks. Because banks see their possibility to benefit from credit expansion reduced as the purchasing power of money falls. Thus, there's an incentive to exploit the commons as fast as possible, because otherwise other banks will exploit it via credit expansion. Nevertheless, competition and the interbank clearing mechanism is a check on the exploitation of the deposits. Fractional reserve banking, therefore, is no pure tragedy of the commons. A pure tragedy of commons has virtually no limits on the exploitation of the common resource. it works like this. A bank that expands credit faster than other banks will lose reserves to the more conservative banks and might fall into severe liquidity and ultimately solvency problems. Only when all banks expand in the same rhythm, there are no reserve losses due to the clearing mechanism. And thus, there's an incentive for banks to collude and coordinate credit expansion. And banks have traditionally pushed for the institutionalization of the coordination of credit expansion through the introduction of central banks. Because the central bank can coordinate the credit expansion of the banking system, prevent reserve losses, and ensure a controlled exploitation of the commons. The central bank, by regulating the exploitation of the deposits of the commons, may prevent the total destruction of the resource and the purchasing power of money. The tragedy of the commons thus is alleviated and converted into what people call a managed commons. The regulation of the banking industry prevents the immediate destruction of the resource by imposing certain quotas and rules on its exploitation. In the same way that governments impose certain quotas on the exploitation of fish stocks in the ocean. Well, we have another layer in the Euro system of externalities. It's a tragedy in the monetization of government debts. This tragedy is unique for the Eurozone because several independent governments can use one banking system to finance the debts by increasing the money supply. How do governments monetize their debts? Traditionally, there have been two instruments by which central banks monetize government debt. One is that central banks buy government bonds from the banking system. The other is that they accept government bonds as collateral for new loans to the banking system. Let's assume here's an example. The government spends more than it receives in taxes. For the difference, it prints some nice-looking government bonds, which are bought by the banking system. The banking system in the Euro system may use these bonds as collateral to get new loans from the ECB. So the banking system gets new reserves and can expand credits on top of these reserves. This is, of course, a debt that does not hurt very much, because what happens at the end of the year is that the government pays the interest on the bonds to the banking system, which they are the owner of the bonds. And of course, the banking system has to pay interest on the loans it receives from the ECB. The ECB at the end of the year, what does it do? It returns the profit to government. So here to see a little bit quantitatively how much it is, how many government bonds are owned by the banking system in Europe. Well, 25, recently almost 30%. The second way is the way that does the Fed. No? We have the same here, a deficit, bonds are issued, bought with money from the banking system, and here the Fed buys the bonds outright and gives new reserves to the banks that can expand credits on top of it. Base money increases. And here the interest is paid directly to the Fed, because the Fed is the legal owner of the bonds, it has bought it, and the Fed returns then the profits to the government. That are debts that do not hurt. The difference between the two methods is mainly legal. In the case of the outright purchase, like the Fed does, the central bank owns the bonds and increases the base money until it sells the bonds back to the banking system. In the case of collateralized lending, like the ECB does, the central bank holds the bonds as collateral and increases base money until it stops rolling over these loans. In both cases, central banks effectively monetize government debts. They increase base money to hold the government bonds outright or as collateral, thus indirectly financing the government's deficit. In addition to this outright monetization of government bonds, there is an indirect monetization occurring within the financial system. Market participants know that central banks buy government bonds and accept them as preferred collateral. Banks buy the bonds, ensuring a liquid market and pushing down yields. knowing that there is a liquid market in government bonds and a high demand by banks, investment funds, pension funds, insurers, and private investors buy government bonds. Government bonds become very liquid and almost as good as base money. They stand as a reserve to be converted into base money if necessary. As a consequence, new money created through credit expansion often ends up buying liquid government bonds, indirectly monetizing the debt. So, let's imagine the following example. The government has a deficit again. The banking system buys the bonds. It pledges them as collateral for new reserves to the banking system. But we have seen the banking system only holds 30% of the government. Where's the rest of the government bonds when it's not in the banking system? Well, China has some, but there's also another one. We have seen that the reserves have now increased. Banks hold new reserves. They have received new reserves. That means they can expand credit. They may grant a loan to a constructor that starts constructing a project and pays his workers. The new money flows to the workers. What do the workers? Well, part of the money they may save and invest in an investment fund, and the investment fund buys government bonds because they are very liquid. So here we see that indirectly the new money creation, a big part of the money creation, may end up buying government bonds because of the preferential treatment by the central bank, because of the direct monetization that is going on. Well, now, in the Euro system, the European Monetary Union, several governments may use the described direct and indirect mechanisms to finance expenditures and please voters. Any government in the Euro system may do the following. It may issue bonds to pay for its deficit. The fractional reserve banks buy these bonds and use them as collateral to receive loans from the ECB. Then the new resource may then be used to expand credit on top. And the tragedy of the commons develops because any government may use the banks and the ECB to monetize their debts. There exists actually an incentive to have higher deficits and print relatively more government bonds than other governments, because printing bonds becomes almost analogous to printing money. The governments that print bonds faster than other governments profit as they receive relatively more new money. So there's a redistribution from the slower printing governments with lower deficits to the faster printing governments with higher deficits. So the redistribution system of the national governments, part of the advantages and disadvantages are transferred to the general population in the respective countries. Takes the example of Greece. Important parts of the Greek economy are not competitive as prevailing wage rates and other factor prices. Yet prices are maintained high by government spending. The Greek government maintains high deficits to pay unemployed, public workers, high pensions and other social expenditures. Thereby, the wages of many Greeks are raised above the free market level. Greeks use then the income to import goods and services from abroad, where they are cheaper. A trade deficit is thereby maintained by the government deficit. In order to pay for these deficits, the Greek government prints bonds that are then purchased by the banking system in order to use them to obtain funds from the ECB or the Euro system. New money is created and tends to bid up prices. While the purchasing power of the euro affects all users of the currency, the costs are shared by all users of the currency, the printing of the Greek government bonds benefits primarily the Greek government and special interest groups that receive income from it. Is it a negative externality? Yes, because the euro is a legal tender fiat money. It represents an infringement on property rights. The printing of government bonds therefore leads to negative externalities in the form of a lower purchasing power of the euro imposed on all other users of the currency. Imagine the following case to visualize the redistribution. The Greek government prints bonds which are bought by the banking system which uses it to get base money and expand credit on top of it. The government pays the money, uses the money to pay a public servant. The public servant buys a German car. Prices of German car tends to rise. The money supply increases. Prices go up while goods flow towards Greece. And slowly the money spreads throughout the Eurozone. the purchasing power of the euro has fallen. There's a redistribution in favor of the first receivers of the new money, the Greek government and its public servants. Other people faced with the rising prices of German cars are the losers in this redistribution. Of course, not only the Greek government may use this mechanism for its own advantage and that of the Greek population, but the other governments of the Eurozone may do so as well. And the government is on the winning side of the redistribution scheme if it prints government bonds faster than other governments. Take the example that Germany prints its bonds, government bonds, at a pace of 3% of GDP, but the rest of the governments print these bonds at a pace of 10% of GDP. So let's assume that the purchasing power of the euro falls 8% per year. Then prices rise faster than the German government prints its bonds. Even though the German government deficit spending is at 3% of GDP, real government spending may actually fall. So the incentives resemble a tragedy of the commons. The incentive is to print faster than your peers. In fact, the system resembles a system where several actors have access to a commonly owned printing press. While the analogy is close, there are some differences. It's not a pure tragedy of the commons. There are some limits. Otherwise, obviously, the euro would have disappeared already in hyperinflation. So what are the limitations of it? Well, governments cannot print euros directly. They can only print bonds. And banks may not buy these bonds. And the ECB might not accept these bonds as collateral. And resulting from this, there are some differences. And there's a Stability and Growth Pact, which I will talk about later. So, why might it not happen that the banks buy the bonds and the ECB would not accept it as collateral? Why would the monetization not work? Well, first, collateralized lending with government bonds may be unattractive for banks. If the interest rate offered for the government bonds is lower than the interest rate banks must pay for loans from the ECB, lending will be unattractive. Second, governments may default on their bonds, and the default risk may deter banks from purchasing the bonds. In the Eurozone, however, the default risk was and still is reduced by implicit bailout guarantees. The euro is a political project. That is all what my book is all about. Thus, we see the importance of the combination of politics and the monetary setup. The euro is conceived as a further step towards the unavoidable political integration of the European Union. Politicians imply that there can only be progress via more political integration. Any regress would imply a defeat of European politicians and put into doubt the whole project of the EU, the whole project of the socialist vision for the EU. Consequently, a default of a member state that might force a country to exit the Eurozone would not only be regarded as a failure of the euro, but also of the greater project of the European Union, the European super-state. And thus market participants for a long time regarded a default as politically next to impossible. The expectation was that in the worst case, the fiscally stronger member states would support the weaker ones. Countries such as Germany or the Netherlands would guarantee the bonds of the Mediterranean nations and prevent a default. Now we know market expectations were accurate. The implicit guarantees have become explicit. Greece and Ireland were bailed out in 2011 by the rest of the Eurozone. Third, banks are faced with a liquidity risk in this scheme, where they use ECB to refinance themselves and pledge government bonds as collateral. Why? Because the term of government bonds in most cases is longer than the term of the loans granted by the ECB. I'm a bank and I have a Greek government bond that is 10 years long. I pledge it as collateral to get a three weeks loan from the ECB. So after 3 weeks, I have to do the same again and roll over until we get to the 10 years. There's consequently a risk that the rating of the bond is reduced over the lifetime and that the ECB stops accepting them as collateral in their lending operations. The risk of such rollover problems is, however, reduced because the ratings of the government bonds are supported by the formerly implicit, now explicit bailout guarantee. The political willingness to save the euro project supports the ratings. The liquidity risk is also expressed by the risk of a change in the interest rates or in the value of the government bonds. Fourth, the ECB might refuse to accept certain government bonds as collateral. And because the ECB requires a minimum rating by rating agencies for bonds to be acceptable as collateral. Before the financial crisis, the minimum rating was A-. In order to support the banking system during a period of falling ratings, the ECB reduced its minimum rating to BBB-. Well, it always said it will only be for 1 year. This implies if government bonds would fall below the minimum rating, they would cease to be acceptable as collateral. However, we have seen the danger of this to happen is not really high either, because the ECB tends to be accommodative. And it has been in respect to its collateral rules for government bonds. As I said, it wanted to cease the reduction of the minimum rating after 1 year. But when it saw that markets or the rating of the Greek government would not achieve an A-, it extended the rule for another year. And the ECB also stated that it would not apply special rules to a single country. But then the Greek government, it appeared that it would not even achieve a BBB-, so the ECB then announced it would accept Greek debt no matter what, even if rated junk, which has already occurred. So a precedent was set, and governments from now on can expect that collateral rules will be changed to support their deficits and the ECB to be accommodative. The ECB is just an instrument, has become an instrument of politics. The fifth is the ECB applies haircuts. When a bank offers 1,000 euros as collateral to receive a loan from the ECB, it won't receive 1,000 but less because of a haircut. And lastly, and this is the biggest danger, the ECB might not play the game. It might not be accommodative to all demands for new loans. So the banks may offer more government bonds as collateral than the ECB makes available. However, the ECB can be expected to be accommodative, as it has been in the past, for political reasons, for the will to continue the political project of the euro, which reduces the risk for banks. So, despite these frictions that I discussed, the possibility to indirectly finance government deficits through the ECB constitutes a traditional tragedy of the commons, and the problems of the setup were known in the beginning, even though to my knowledge no one has called it before a tragedy of the commons. Thus, to restrict these perverse incentives, Germany and other relatively hard currency countries enacted the Stability and Growth Pact. The Stability and Growth Pact intended to limit the debts and deficits of member states. According to the Stability and Growth Pact, government debts shall be below 60% of GDP and deficits below 3% of GDP. Thus, the Stability and Growth Pact acts as a managed commons because it imposes quotas on the exploitation of the common resource, the purchasing power of the common currency. Of course, the incentive is to exploit the quota to the maximum, that is to have a 3% deficit, 3% of GDP deficit. This is the incentive if the quota is really enforced. However, the Stability and Growth Pact was never enforced. It utterly failed because governments themselves decided on the very sanctions that they would have to enforce upon themselves. It's like a system that resembles a cartel, where cartel members promise not to exceed a quota of 3% of GDP deficit. And thus the services of the exploited resource, the purchasing power of money, is kept from falling fast. Yet the cartel is not enforceable, and the incentive for members is to exceed the quota to benefit on cost of members fulfilling the quota. In fact, in 2010, all Eurozone governments had a deficit higher than 3% of GDP. So, we have seen there are three layers in the Eurozone of negative externalities. One is the production of base money, property rights not defended, then production of fiduciary media, property rights not defended either, and then there's the tragedy of the commons also in the monetization of government debt. And of course, how do we eliminate these negative externalities? Well, simply by defending and defining well private property rights. Of course, the more of the externalities that we do eliminate, the higher will the resistance of the privileged class of the current system, which is the political class and banks and big business. So let's look at the different options that there are. This is a table where we have the negative externalities on the top. On the right is the external negative externality due to the base money production. Then we have the tragedy of the commons due to the production of fiduciary media by the fractional reserve banking system, and then the euro area specific tragedy in the monetization of government deficits. So, and then they have the monetary setups. In the current euro system, the externalities are high, negative externalities are high for all three. A reform would be to enforce the Stability and Growth Pact, for example, with automatic sanctions. Any government that exceeds the 3% government deficit gets an automatic sanction. So this would limit the tragedy of the commons in the monetization of government deficits. However, Germany and the EU Commission proposed automatic sanctions, but even this modest reform seems to be not to be possible because there is resistance from other governments against this putting limits to their possibility to monetize their debts. Another reform similar is the monetary growth rule by Milton Friedman. There we would limit the negative externalities from base money production. For example, if we say the central bank can only increase base money 5% per year, it would be limited. Implicitly, it would thereby also limit the monetization of government deficits. Of course, the tragedy of the commons caused by the fractional reserve banking system would remain in place. A system of national currencies that is returning to the Deutschmark, the Lira, the Frankfurt, this would, of course, eliminate the tragedy of the commons and the monetization of government debt through the euro system, because the euro system would cease to exist. So there's none. The tragedy of the commons in the production of fiduciary media would remain, and also for each government could still use its own central bank to produce base money and monetize its debt. The next system would be fractional reserve free banking to abolish central bank, abolish legal tender laws. Of course, there would be no tragedy of the commons in the monetization anymore, and no external effects of monopolistic base money production, because anyone could produce currencies. There would, and through the clearing mechanism, the tragedy of the commons of the fractional reserve banking system would limit it. And lastly, eliminating all external negative externalities would be clearly to restore property rights, to defend property rights 100%, define well property rights in money. That is to return or to go to a 100% commodity standard. There would be no tragedy of the commons in monetization, no by fiduciary media, nor base money. So, to conclude, we are faced with several layers of negative externalities in money due to ill-defined and ill-defended property rights. We have a tragedy of the commons in fractional reserve banking, the production of fiduciary media, and of the monetization in government debt in Europe. And we can group monetary reforms and systems according to the extent that they eliminate these negative externalities and perverse incentives. Only a 100% commodity standard would restore property rights fully and eliminate all negative externalities. let's hope that we can go to the system without or before a total collapse of our current monetary system. But for this to happen, we have to win the battle of ideas. Good luck to all.